Well, how's it? It's 7 o'clock this evening, and we have got a webinar for you. We are doing the 7 o'clock time because we've had feedback from our community to say that they quite enjoy being able to sit down after the dinner and put the kids to bed and whatever, and then start absorbing interesting information. And I'm really happy to be talking with Stephen Nathan today. Stephen is the Chief Executive of SWAN Investment Management, but he's got a long story, a long history. We've got a long history, Stephen. I remember interviewing you at the SABC in the dungeons at the SABC on Radio Park when I just started in 1997, 1998. I remember doing an early morning show, and there you were, happy to come in. That's a long time. What's it? Coming on for nearly 30 years ago. And I followed your career with great interest because it's been one where the integrity has shone through. We also followed your creation of 10X, which really was a different approach towards investing for individuals. And now you've got a new venture. But before we go there, just very briefly, 10X, it's a big business now. But when you started it, you certainly had I suppose one could say in a way, a bit of a higher purpose.
Yes, that's right, Eric. I'm wondering if we even met before then when you were at ABSA. I can't remember what year you were at ABSA as well, because I started off as a banks analyst, and spending 10 years at Deutsche Bank in South Africa and globally, very much involved in the analyzing the financial sector and talking to fund managers, and you realize how complex the investment environment is, and quite frankly, how disempowered most people are in terms of, how should I save sensibly? If I'm saving for my retirement, how do I save it sensibly? Because there's so many options, and there's competing choices, and there's conflicts of interest. And the whole idea with 10X was, firstly, it was empowering because I had a blank piece of paper. So I had no preconceived notions and I had no biases. And I said, if you can provide one investment strategy that would be appropriate for different people that all have a same common goal. Because you say, yes, we're different income-wise and we're different demographically, but at the end of the day, when you're saving for retirement, a goal like retirement, you all want to have enough money to live. And that was the whole idea behind 10X, which was to say, how can we get there? And we came up with what we call the retirement formula. If you save 15% of your salary from your first paycheck to your last paycheck in a high equity fund with low costs, and we back tested that over more than 100 years, you would always have had enough money to retire on it. And that became sort of the genesis. And then we filled in the pieces with, have high equity for as long as you can, because you've got time to ride out the market downturns. Index, because the vast majority of fund managers can't beat the index mathematically and empirically. We see that. Minimize fees, stay the course. Quite a simple formula, simple to do, not that simple for us investors, given all the distractions and the activity in the markets. And that was the idea behind 10X. And what I'm really proud about it at 10X is that most of our clients were invested for the long run in the high equity fund. So about 85% of investors were all earning the same returns. And those returns before fees were above the large fund manager, and after fees you would be sort of top quartile. And almost all of our clients were getting that. It wasn't a situation where we had, let's say, an AI fund or a resources fund and a tech fund, and at any one point some of your investors are doing well and a lot aren't. So that was the 10X story in a nutshell.
Yeah, and we won't go through the departure therefrom. I remember when we spoke about it at the time, I felt there were some parallels with you and I. What happened with me at MoneyWeb? It was supposed to be your life's work, but you've moved on. They gave you quite a long gardening leave, and now we're talking about the new venture, and it's really exciting to me for many reasons. One, everybody needs offshore rand hedges right now, cheapers. I mean, we don't need to start talking about South Africa's political situation. So let's just put that to the one side. But secondly, you don't always know who to trust. And what I know is I can trust Stephen Nathan, because we've gone a long, long way together. And I think members of our tribe will be able to take quite a lot of comfort in that. And really tonight, we're going to go through SWAN, your new business, your new operation. we're going to explain a little bit more exactly what it is that you are doing this time around and why it's superior to many other options that are available. So, Stephen, I'm running the little presentation. It's relatively short, and then we'll take questions from the community afterwards. And the way, by the way, incidentally, to post your questions is literally just put it on the chat box and type in your questions there, and I'll pick them up and push them through to Stephen as we go through. But if you can just tell me when to swap the slides, and let's go through your presentation.
Great. Thank you. So, Alec, as you said, when I exited 10X, it was also a liquidity event. As you know, as an entrepreneur, your life, your energy, your money, everything's tied up in your business. And when I exited, I had a liquidity event, and then obviously the opportunity to start investing my own money, outside of a business. And obviously, one of the first issues was to externalize, what wasn't needed in South Africa. And then it was about how do I invest my own money? And what is quite interesting is that at 10X, it was all about retirement funds, which is Regulation 28. So there's quite a lot of constraints, which means you don't have to think that much because you can't have more than 45% offshore. So you can't think of, well, should I have 100% offshore? You can't have more than 75% in equities. And it's very hard to access private assets, quality private assets. So it's quite narrow. And here, once again, I had a blank piece of paper and I looked at, what are the investment opportunities? And maybe if we move on, well, maybe just starting at a high level, what you're looking at over here is what they call in the US multifamily real estate. And multifamily is really a fancy name for apartment complexes where there's one title deed, one owner, and all the apartments are rented. So effectively, it's a rental income stream that an investor owns. And we're probably more familiar with the term condominium. Condominium is an apartment complex that is owned, sectional title. And one of the asset classes that I was very pleasantly surprised is when I was doing some work a few years ago, and someone said, you should look at multifamily real estate in the US. And I thought, well, I've missed the last 4 real estate cycles. Surely, this is not the right time. And this is an asset class that we believe investors should seriously consider as being a component of their overall portfolio. And this particular development is a development where in our first fund, this is our second fund we're launching, we own about 10% of the equity in this development. So this is kind of what we're talking about, Alec. We can move on.
Stephen, it looks a bit like Baldwin in South Africa. Is it similar?
Well, Baldwin doesn't rent, so they develop to sell. So they are developing for sale. This is a development for renting. And also when we talk a little bit about the underlying financing in the US is so much more attractive. Interest rates are so much lower and the markets are so much more liquid. Whereas in South Africa, when you want to get finance for construction, it's very challenging and you've really got maybe the big 5 banks. Whereas when you go into the US, the depth of those capital markets is so vast and the interest rates are so much lower. So we think to own a leveraged asset in the US is much more attractive, low interest rates, and much stronger top-line growth, much stronger demand, job creation, wealth creation, and population demographics as well.
What I'm getting at, though, when I look at the Baldwin projects in South Africa, they also seem to be multifamily, how did you describe it, complexes where it's flats, really, and lots of people who live high-density living there. They have gyms and entertainment areas, etc. So it becomes a bit of a community in there. Although I guess at Baldwin they do sell as well as rent as well. But it just looks from the social demographics here, it looks very similar.
Yeah, you're right. Now, from that aspect, it's very much community living. It's almost as if you're walking into a hotel. So these multifamilies, you walk in and it's as if you're going to the foyer of a hotel where there's a lovely lounge, there's an entertainment area, a beautiful pool. This is a development in progress. So you can't, this is not the finished product, but you can see there's a pool that, overlooking a lake, fantastic amenities, office. So a lot of people work from home. There's boardrooms. you had entertainment, you have lounges, you've got walking parks, cycling parks, dog parks. So it is very much a community.
Okay, so we've got an agenda. You want to take us through it quickly? In other words, tell them what you're going to tell them.
Okay, so we'll talk about global investment trends and some challenges. Then specifically why we think there's a case for US multifamily real estate. Then the actual opportunity. So what is our investment strategy and what is the opportunity that we have? And then just some logistics. Obviously, Alec, we must say we're in financial services. Disclosures and risks are really important. We are a financial services provider, but this investment opportunity, because it is a private asset, it is not a listed investment. It is not a collective investment scheme under the CISCA Act of South Africa. And therefore, we are not giving investment advice. And investors must seek their own independent financial and tax advice. So it's important that we stress those risks.
Stephen, is it similar to Orbvest? I know Orbvest focuses on a different area, but they mainly in South Africa, they've got a different structure because they work through Seychelles, for instance. But
yes,
with Orbvest, they're very focused in medical property in the US. Are you, in a way, offering something parallel to what they're doing, but of course with multifamily real estate instead?
Yes. So you're right. There are similarities. We're both investing in the US in real estate. As you say, my understanding is they on the medical side, whereas we on the residential apartment side. But investing into the US, and then they have their structure through Seychelles, and we have a structure through Guernsey. So as a South African investor, if you invest directly into the US, you could be subject to inheritance tax, which is called CITES. So you could pay 40% of your wealth, or your estate could pay that. So it's quite tax inefficient to invest directly, and that's why you need these, a structure to do that. And we have that Guernsey structure, but similar to Orbvest, the underlying asset, the domicile, and the structure.
And Guernsey is a tax haven.
Yes, let's call it a low tax jurisdiction. So it's very investor friendly. So we had independent Guernsey directors. So it's a well regulated environment, and for investment purposes, your assets are well regulated. They are ring fenced, and then there's no tax paid in the investment fund. So our structure is very tax efficient. So if we look at
we're getting into the meat now, Stephen.
We're getting into the meat. Okay, so what's always interesting is what returns have investors earned over the past 5-10 years. And if we look at global returns, it's really been the US, as we know, that's been the engine of growth. So over the last 10 years, if you look at sort of global equities in dollar terms, you've been getting sort of 10%. And most of that has come from the US, because over the last 10 years, the US has generated 13% per annum dollar returns. And that's quite a bit above its long-term average, which is at 10%. So what we've seen is good returns, but a lot of those returns have come from the multiple expansion. And I'm sure, you've spoken about this and everyone knows that the PE on the S&P 500 is at even higher levels than it was at in the late 1990s, the TMT boom. So all we're saying is that, multiples are high, and if we look forward, the next 10 years, returns are not likely to match the last 10 years. So, long-term equities are still a good place to be, but we're saying future returns are probably going to be more modest, and we think investors should look elsewhere to complement and diversify their portfolio. Global property and global bond returns are projected to be sort of 4.5%. A lot of the investment houses, their expectations for global equities, and you can see some of the big names over there, it's about 6% in dollars. So we're saying, are there other asset classes that offer attractive risk reward? And we think within private real estate, the multifamily space, we can achieve, and we're certainly targeting 10 to 15% per annum in dollars net of fees. Now, that's not a guaranteed return, but those are what our model, using sensible assumptions, is what we expect to get. So one of the big themes we're seeing is this move to private assets. A lot of the high net worths are investing more in private assets. The sort of projections are that up to 40% of high net worths have 40% of their assets in alternatives or private assets. Let's call them private assets. Now, in itself, that's not necessarily a good thing. The fact that everybody is investing in an asset class, often that can create too much money, chasing too few opportunities and suppress rather than enhance returns. So it's never good to blindly follow these trends. But we do think that the private real estate offers interesting opportunities. And it's about 12% of high net worth portfolios, which is about 3 times what they have in hedge funds. So real estate is a large asset class, but it's largely underinvested in.
I think there are a few things that are worth just unpacking here, just to make them a little more simple for people who maybe are not financial experts. When you talk about the rating or the average price to earnings ratio being at its higher even than with the dot-com boom, what you're saying here is share prices are expensive. And so at the moment, it's unlikely, or history suggests that they're not going to stay there indefinitely. You're going to have an economic boom to keep them even in a reasonable level. But the stock market is projecting fantastic profits from companies that don't always deliver. So as a result of this fabulous run that we've seen in share prices, when one looks forward on the experts, and you did mention there, people may be not able to read the detail, but Goldman Sachs, JP Morgan, Morgan Stanley, BlackRock, and Vanguard estimate that global equities will be about 6% a year from here in the next 5 to 10 years, probably 4% in bonds, 4.5%. But the SWAN, your business, the thing that you've now gone and looked internationally for yourself and for your own wealth, you're targeting 10 to 15%. And I think that's the important thing. And you're going to now tell us what it is that you found looking for yourself, and you're going to share clearly with others, a little bit like what Orbvest did as well. Those were 3 entrepreneurs. They got together. They wanted to invest offshore. They'd sold businesses in South Africa. They did a lot of work. They knew a lot about the medical property field. And so that's where they went into. Henny Bezuidenhout had developed many medical properties in South Africa, and that's really their focus. So there are some parallels on that one. But let's get on to the next of the slides now, Stephen. And here you can make the case, as it were, for US Multifamily.
Yes, so there's 3 main reasons why we like the US Multifamily. The first, and I mentioned this earlier, is that the US has amongst the lowest real, so those are interest rates after inflation, in the world. And as the world's reserve currency, it means that the US is better able to manage its monetary policy in the long run because it is the world's reserve currency. And there's very deep and liquid capital markets. So access to finance in the US is very, very broad. You've got banks, you've got family offices, you've got credit funds, even government. Fannie Mae and Freddie Mac provide subsidized financing for real estate. So low interest rates is really important. Then you've got strong demand. So you create demand in a prosperous economy. When you have economic growth and you're creating employment, then you're creating household formations, and there's more people that are able to afford homes. So you have demand there. Population growth in the US is about 0.7% per annum. That's population growth. But what is interesting, Alec, is that there's a lot of migration between states. So we're seeing, states like Florida and Texas that are growing at a much faster rate. So the national is one, but the demand between the states is dramatically different. And then another massive demand driver is the affordability. And this chart is quite fascinating. It shows you the difference in America going back over almost 20 years now. The cost of owning a home versus renting. So the red, that more volatile line, which has actually gone up 50% post-COVID, is it's never been more expensive to buy a home. Because when you're buying a home, you've got house prices, which have risen 30% in the last 5 years, and you've got mortgage rates, which have gone up dramatically. So the cost of owning a home has doubled, and the cost of rents grow over time at about 3% per annum. So it's 70% more expensive to own a home than to rent a home. So as a consequence, the demand for renting is very, very strong. And there's also other demographics, work from home. So people are more flexible in where they are living. People are also getting married later on in life. So they are, buying homes later on in life. So there's also demographic factors. But, this chart tells you a lot about the housing market in the US. Now, when you look at
very,
supply,
very interesting. Sorry, Stephen. Just to add there, from the younger people today are also very keen to rent rather than buy. It's a whole almost cultural shift. We've got quite a number of questions, and I'm wondering if we should ask the questions or ask them after you've zipped through the presentation, because it sometimes is better to have the interactivity. Are you comfortable? Maybe can we just pick up on the first of the questions? Because I think you made the case there on why it makes sense rather to rent than to buy. I mean, that picture is very clear. But Rich was asking, he says, what do I own? Sectional title of a flat, or is it shares in the share block, or how do I sell it? So I guess that's kind of a key question. Are you going to answer that later?
Yes. Should we answer it now, Alec? Do you want to go to the relevant?
Yeah, man, I think so. And then we'll go
okay,
through.
Then if you don't mind, maybe let's answer it visually as well. Alec, if you don't mind.
Cool. Of course. Which one?
The most highly, here we go. The most highly paid teleprompter I know. Alec?
Yeah, there we go. Cheapest.
Where we? Okay, not that one. Let's go. It was the one. Sorry, you were there. Go up, please.
They go backwards. Go back.
Yeah, stop.
What did you say?
Okay.
Got it.
All right. So this investment structure, it's called an AMC. That is the investment vehicle. It's like a collective investment scheme. That's the Guernsey structure. So investors, should they want to invest in this type of opportunity, they buy units in the AMC as you would buy units in a unit trust fund. That's the Guernsey structure. That fund then has three underlying investments. And we invest in the common equity. So the equity of each development. So you can see there are three underlying properties. These are ground up developments. So we partner developers who have secured the land. They've got the permitting. It's what's called shovel ready. So by the time we invest, our development partners have owned the property for between 2 and 3 years, and they're ready to break ground. We own the common equity. There is a senior debt and there's a mezzanine debt. So there's debt provided, which is roughly about 70 to 75%, and the equity is 25 to 30%. So our fund is a shareholder in each development, and each development is housed in a company in America. It's called an LLC. It's a limited liability company, a Delaware limited liability company. So that's what we own, because each development is it's a property with one title deed. We are the owners, and there are, for example, in Tuscany Village, it's a 420 unit apartments. So 420 apartments. There's 420 apartments that are rented, one owner, and we have roughly 10% of the equity in that development.
Okay, got it. So it's a little bit like, if you can imagine a investment trust in a way that has got investments into three companies in the US, and those companies are themselves quite specialized in that they own these developments. So you've got 10% of each. What is AMC? What does that stand for? You mentioned AMC.
That's for an actively managed certificate.
Okay.
Actively managed certificate. So it is it's a legal entity that houses investments in a ring-fenced manner. So you could have multiple AMCs as you would have multiple funds, and each fund is ring-fenced, meaning that other assets that might be in that jurisdiction are not contaminated.
Gareth asked a question. He says, for simplicity's sake, does the AMC fund operate like a local South African REIT, real estate investment trust?
No, it doesn't. It doesn't for a few reasons. So the first is that we are investing in developments, and these developments have in our AMC, our second AMC, the expected development time horizon is 2 to 4 years. So we develop, or our partners develop, we tenant it, and then we sell. So in that period, we are not receiving a rental income. We are not paying out a yield. We are investing for a capital appreciation. So after between 2 and, it should be 3 years, but maybe things get delayed a bit, we will then exit the property, and all investors in the LLC, so let's take Tuscany Village, where we think in 2 years' time, we will be exiting that, we'll sell it. All investors, including ourselves, will then get our return back as a capital gain. We then distribute that to our investors as a capital gain. So it's a roll-up fund. You tax as capital, not as income, and that is the distribution. And our investors get that return as a capital gain. It's a very tax-efficient structure. There's tax blockers and tax structures to minimize the tax. So it's not a REIT where you're getting your income tax-free and then you're paying either, in the investor's hand. Here you're getting a capital gain, and then you would pay capital gains tax according to your specific tax status.
So that also answers another question here. Of the assumed return, what proportion is modeled as rental income and what is the capital appreciation?
Yeah. So it is all, when I say all, it's the expectation is that everything will be a capital gain.
Mm-hmm. What does the US law say about non-US citizens owning property in the USA? That's from Rich.
Yeah. So we are owning a company that owns property. That's the first thing. The second thing is that we are not coming in as individuals. It is a Guernsey fund structure. So an investment fund is able to own a company in the US. There's no prohibition against that. A non-US investor into the US is subject to 30% withholding tax. And we have tax blockers. There's tax blocker structures which mitigate and minimize that. So legally, it's not a South African, it's a Guernsey structure. And there's no prohibition on a Guernsey structure investing in a corporation, and that corporation then owns property. So these also, I think what's important, Alec, is that this structure has been used for many, many years. It's not something that we have sort of broken ground on ourselves. These are very well established structures, and our partners, we have two partners. The one is Miami based, and we work with them in Orlando, and we have a second one that is Brooklyn based, and we work with them in Brooklyn. Those are the two cities that we are investing in, the two locations we like, and they've been doing this for many, many years.
Michael says, where does an investment of this nature fit into a broad multi-asset portfolio? Would you consider the risk-return profile alongside equities or between equities and bonds?
Yeah, it's a good, it's a good question. I think that property in general, we say would sit between equities and bonds. If you look at the return drivers of our investment, because the return drivers are actually quite simple, is that there's two numbers we focus on when we do evaluation. The one is our rental income. So it's your rental income less your expenses. Your rental income is two numbers. It's what is the rent you're getting per square foot and your occupancy. So in strong markets, strong economies, we expect to have strong rental income because there's strong demand. But also in strong markets, interest rates tend to be quite high. And your other variable is the valuation, what they call the cap rate, which is the inverse of the multiple. And when interest rates are high, your cap rates actually tend to be high as well. So they suppress the valuation. So it's got characteristics of equities, which is driven by strong economic growth, and it's got characteristics of debt, where interest rates, you'd be better owning debt when interest rates are falling than are rising. So it sits between, the two. We do think that the risk is relatively low because we own a real asset in a very strong economy. So if the market turns down for whatever reason and we're not able to, achieve the rental income that we expect, we're still holding a tangible asset in a very strong economy, and we are partnering developers at cost. So we coming in at a cost, and we exiting at a market-related value over a 3-year period, and that's sort of where the projected uplift comes. So if things really go bad, we can never say that you won't lose money. We can never predict that. But the scenarios that we have modeled and looked at says that it's very unlikely that we would have a capital loss. Then you say, well, where does that come in over a 3 or 4 year time horizon? Because in equity markets, there's roughly a 1 in 3 chance of a negative return in any 1 year. So over 3 to 4 years, the probability of you having a down year, is in the order of sort of 10, 15%. And we would say, we think this is less risky, but we can't guarantee that.
Stephen, another question from Gareth. Are the exit dates defined in the agreement? Are there lock-ins for investors, or are the AMC units always liquid?
Yes, so that's a great question, is that because this is a private asset, liquidity is not good. So what we say to prospective investors is that this investment has an expected time horizon of 3 to 4 years. And therefore, you should be investing money that you don't need over 3 to 4 years. So if you need liquidity over 3 or 4 years, this is not an appropriate investment. So you should look at your overall portfolio and say, if I look at my holistically, where can I invest for 3 to 4 years? To be honest, most investments should be at least 5 years. If you're investing in the equity markets, it's also advisable to invest for 5 years. But obviously, there's much more, there's liquidity. So the time horizon or the investment term is 3 to 4 years. We do have the right to extend that for 2 years, but we'll only do that under market conditions. So I think what's really important is that interests are aligned. We at SWAN are investing at least 10% of the capital. Our own money will comprise at least 10% of the fund. And more importantly is our development partners have their money at risk. So our development partners only make money if we make money. So interests are aligned. The term, as I say, we can extend that. There's no lockup clauses. There's no liquidity penalties at all. If somebody does want to exit, then we just have to find a buyer and implement that at the best price that we can.
And that's something that I wouldn't expect anything different from you, Stephen Nathan. Okay, so we've gone to the first one. Why US multifamily rental apartments? Can we go on back to your presentation and go to the focus here and talk us through this slide?
Yeah. So the US is a big place, and we have settled on 2 cities, Orlando in Florida and Brooklyn and New York. I'm sure a lot of people are familiar with Orlando. It is the 7th busiest tourist airport in the world, 58 million passengers. But in addition to tourism, it is a very vibrant economy. The infrastructure, a lot of companies are moving their offices to Florida and specifically to Orlando. You can see the population growth has been very, very strong. So Orlando is growing at 3 times the national average. There's no state tax. It's very business friendly. A lot of retirees are moving there. So it's a very high demand city, Orlando. That's why we've chosen that as one of our cities. And in Brooklyn, New York. Brooklyn, what is incredible about Brooklyn is that it has been bulletproof. If you look at occupancy rates, so we can see in the US nationally, you can see the top slide there is that occupancies in multifamily apartments are about 95%. Obviously, coming out of COVID, that has fallen a little bit. So nationally, it's about 1% down. So there's about 6% vacancy. But if you look at New York, Brooklyn, it's actually on the rise. It's between 98 and 99%. So the demand in Brooklyn remains incredibly high. And you also see that in rent growth. where rent growth, you can see the national average below, it's sort of up at 8%. So coming out of COVID, there was a spike in inflation, a spike in rentals. That's now come off. It's hovering at about just under 2%, long run at 3%, whereas New York, Brooklyn's about 6%. And the specific area that we're investing in Brooklyn is Williamsburg. And in Williamsburg, over the last 12 months, rentals have grown at 14% year on year. So you've got these pockets where there's very strong demand and very strong rental growth.
Why would Williamsburg be so popular?
It's a great location. It's very close to Manhattan. So you're only a couple of stops on the tube, the subway. Just very well positioned. A nice family neighborhood, well maintained. So it remains very, very popular.
One of the sweet spots of New York. Garrett's follow-up question. You mentioned the structure of the property as a single owner and the units are all rented. When the exit occurs, to whom is the fund selling?
Oh, good question. So the finished product is one of the following: an institutional buyer. So there's an institution. If you look at the assumptions to give you some sense of the numbers, is that in Orlando, we're projecting that when we exit that project, we will sell that at what's called a cap rate of 5.25%. So that means the buyer will buy an asset that has 5.25% yield, and that yield will grow with rental income at about 3%. So they'll be expecting a total return of about just over 8% in dollars, and that'll sort of go into perpetuity. So they'll look as an institution. They'll say, okay, well, if I'm getting 4%, 4.5% on bonds, and my bond yield I get 4.5% every year, where does an asset that's giving me 8% fit in that? So an institutional buyer, it could be a family office. They have a lot of real estate funds as well. So there are dedicated funds that want to buy the end product. So institutions don't want to take the development risk. They don't want to be able to manage small developments. Institutional buyer has a big pool of assets and they want to buy a finished product.
Okay, we have touched on this slide already. Just that perhaps at the bottom, the net return of 10 to 15% per annum. That is high. How?
Sorry, that is high or how?
It's high. How do you get that?
How do we get? Yeah. From? So as I said, let me give you an idea, Alec, of the capital stack over here. Is that we in these projects, you tend to have senior finance, a construction loan, and that's about 8%, paying interest of between 7 and 8%. So we have a senior loan at that level. We then have the pref, the mezzanine, the mezz debt at about 12%, and then the common equity. Sorry, can you still hear me, Alec? I seem to have lost you.
Yeah, I can hear you. Yes.
Good. Okay.
Carry on.
Okay. So that is the structure, the capital structure. Now we're owning the equity, and when we do the projections, we take in account the cost of debt into our numbers. And we are developing an asset with a yield at about 7.25%. And then the expectation is that we exit at a yield of 5.25%. Now that might not sound that much. 7.25%, you buy and you sell at a much more attractive valuation, 5.25%. But on those numbers, with that leverage, the dollar returns are in the region of 20% per annum. So those are the returns that our partners have achieved in the past, and those are the projections on that basis. So we are taking some development risk, and when you're taking development risk, you do expect a higher return. As I mentioned, the end product investor would be getting about 8.25%.
Right, onto the first investment, Tuscany Village. Now, you have explained to us that you've got that it is the fund invests into 3 projects. This is the first of them. Do you want to take us through this one?
Yes. So Tuscany is a project we know well because our first AMC is an investor in this project. And the reason that we are having a follow-up investment is that this project is performing so well. And our objective is to try and de-risk our investments for our investors. So we have an opportunity of having another investment in a project we know well, and that is already 1 year down the track. And what is really interesting, just to give you, I mentioned some sense of the timeline, but this project broke ground in April of 2024. You can see on the left-hand side there, in September 2024, 5 months in, my partner, Dave Murray, and I visited the site, and they'd cleared the ground. They had laid the concrete was laid for the 7 buildings, but it looked like a long way to go. And what is interesting is if you look 5 months later on the right-hand side, you can see how this project has been transformed. So the standard and the quality of building, this project is under budget. So we're coming in quite significantly under budget, and it's on time. And I think what's also important is that those who follow the weather will also know that Florida is a high risk from a weather perspective, and in between this 5 months, Hurricane Milton and Helen also hit Orlando. Now, obviously, this is something that we are well aware of, and we did a lot of work in as best as we could in trying to understand the hurricane path and the weather patterns. So we're not in the hurricane path, and we are outside of floodplains. But nonetheless, there was 3 weeks where there was exceptionally heavy rain, and our site was impacted. But it's quite incredible to see the progress that has been made, despite some weather activity.
On to the second development.
On the left-hand side, this is another development in Orlando. Orlando is a large city. This is about 60 kilometers apart. And also, I mentioned scale. Florida has a GDP of $1.6 trillion, which is over 4 times the GDP of South Africa. That's Florida, which is, one of the 50 states in America, just to talk about the scale. But Orlando, which is just a city, or fairly sizable metro area, has a GDP of $200 billion. So it's a really vibrant, large economy. And this is a project with our same development partner and the same contractor, and very much a cookie cutter approach. So maybe there, Alec, with your Baldwin, is once you have a model, you replicate that. You aesthetically you change the few of the facades, but you're largely replicating this in different areas. We like the project, we like the area, we like the contractor. So here's another opportunity for us to diversify and get it very attractive, because the economics are similar here. Is that our partners, the projections of the returns are once again at the 20% dollar level. Now we are a little bit cautious. We trim some of the numbers because we don't want to create unrealistic expectations. But it's another project that we think has got good upside potential in a very strong market.
What does it mean, ground up development?
Yeah, so ground up means that our partners are buying a piece of land. There's no building on the land, and they're basically building from scratch. So that would be, if you look at our third investment, which is a repurpose. So this is in Brooklyn, in Williamsburg, as we mentioned. It's a beautiful Art Deco building, and here what our partners are doing is they are redeveloping. The bottom floor has 3 tenants. We are keeping those 3 tenants. There's a bank and some offices. So we have 3 tenants there. We're keeping them. But the floors, there's 6 floors above, and those are being repurposed into multifamily apartments.
It was interesting, your point that you made about Orlando with a $200 billion GDP. That is half or over half of South Africa's, the whole of South Africa. And it really does put it into perspective when one considers the size or the heft of the United States. And many South Africans probably haven't even heard of Orlando. Well, they've heard of Disneyland, so they would have heard of Orlando.
Yes.
But it just puts it very much into perspective. Tell us a bit more about that repurposing. Number 3, how does a building like this even come onto the market, given that New York is so well developed?
Yeah. So this was an old YMCA building, and it was used for offices, but it never fully recovered from post-COVID from an office perspective, because you probably know that even New York, the hustling bustle in New York, has not recovered office space, office-wise. So it was a building that where the owners, were getting very poor occupancy and very poor rentals. And our partners here have a very strong on-the-ground presence. Our partners are currently developing 5 properties in Brooklyn. So they are in the know, and they were able to negotiate directly with the seller without it going on market, do a quick deal on attractive terms. And over here, we also, it's a developer that we are busy doing a project with in our first fund. We know them well. And they're also using the same contractors. So for us, Alec, one of the most important, probably the most important issue is finding the right partners on the ground. I mean, you mentioned, having people with integrity, especially when it comes to investing. So you want people with, integrity, track records, and skin in the game. And they are able to find these opportunities and to convert these opportunities.
And you've got 20% of the equity. So you own 20% of this building, in effect.
So we will, that's exactly right. We will have 20% of the equity.
Another question, does the AMC2 fund have a minimum cap raise before deployment? Or
yes, okay.
Is it going ahead no matter what?
Yes. So we do have a target of what we need to raise. We are confident of getting to that number. And when the raise closes, the fund will close. It's not going to be open-ended. So we don't do secondaries. We're not looking to raise more capital. We have committed to these 3 partners, and we'll raise that amount of money needed, and then invest that almost immediately. So all these projects are actually on the go. So our partners are at various stages. They have adequate financing, and as soon as we close our AMC, we will then contribute our share to these 3 developments.
Can you tell us a little more about that? Because I'm sure somebody might be saying, well, if the projects don't go ahead, then I've got capital tied up. How does all of that work?
Yes. So Alec, these three projects. So let's take Tuscany. Tuscany is happening. It's a year down the line. So that project is on. The second one, Lake Nona, they actually closed Lake Nona in January. They closed it. Our fund wasn't yet ready for that, and they were fully subscribed. But because we have relationships with these partners, and more importantly, both sides are looking to grow these relationships over time, is they have given us an allocation into a development that's closed. So it's not that easy to get allocations to these, especially the high quality developments. There has to be some kind of relationship there. So this project, Lake Nona, has also started. So I can share some photographs of the site, but it is a construction site. So that's underway. I think maybe what I should have said, what's really important here is that in the financing, so the senior lender provides 60% of the funding. So they're the anchor tenant. Without a senior lender, these projects don't fly. Now, the senior lender they're very professional. I mean, this is a very professional, well-run lenders. They do extreme amounts of due diligence and ensure that Give you one example is that you have a construction bond in place that if the developer goes under, there's insurance to cover the cost of getting a new developer. So there's lots of checks and balances that they have. And they will only sign, the senior lender will only sign their commitment once all the equity is in the project. So it's obviously got to be shovel ready, it's got to have all permitting, it's got to have all zoning, etc., etc. And they won't commit, the senior lender won't commit until all the equity has been put in. So there has to be adequate equity to fund the project, otherwise the senior lender won't lend. And if the senior lender won't lend, well, the construction won't start. So we're investing in projects that all these 3 projects are on the go. And our third project, Marcy Street, the developer has already bought the building. So they have bought the building and they are in progress of repurposing. So there's the project have started.
Another follow-up question. In terms of exit, do all 3 projects need to complete and be sold before returns from the funds are distributed?
No. As an investment is realized, so we return capital to our investors. So there's 3 projects. Our expectation, and this is just an expectation, is that after 2 years, we would have exited one of our investments, and then let's call that a third. Then we will distribute that capital to our investors as we receive it. So we're not holding capital for any amount of time, and we're not recycling capital. We're not saying, okay, we're going to hold on to that until another opportunity. The fund has a finite term, and it's got 3 finite projects. As soon as each project is realized, we then return capital to our investors.
On to the next slide, risk mitigation strategy.
Yeah, I think it's really important that we focus on risk, because investing is largely driven by risk. The first thing is what can go wrong, because we know how many things can go right, but it's much more important to understand what can go wrong. And Alec, we never got a chance to talk about this, but the name of our company, SWAN, SWAN stands for sleep well at night. And what I've realized is that if you've got too little money or too much money, money can be a source of a lot of stress. And what we're trying to do at SWAN is to ensure that our clients and our investors, are invested risk appropriately, so they don't get unpleasant surprises. So risk is very important to us. Risk, there's a lot of work done around the governance and the legal to make sure who we are contracting with. We do our own risk. Very importantly, in Guernsey, our AMC administrators, they do a fortune of work on due diligence, on legal due diligence, who we're contracting with, who the beneficial owners, what are the structures. So there's a lot of work done around that. On project risk, so the risk there is we don't build on time and on budget. I did speak about some of the contingencies, construction. If the general contractor goes under, we have insurance that covers the cost of that. Obviously, a general contractor can go under, so you don't want to be with small players. And what we've seen is that a lot of the small players, let's say the less reputable, well-capitalized developers have been taken out. It's a bit like Warren Buffett. You can see on the right-hand side what's interesting. The reason I'm showing this chart over here is that construction loans are priced off what's called SOFR. It's the overnight rate. And it's the 30-day SOFR rate. And you can see, money in the US was more or less free, 2020, 21, 22. So a lot of these deals look fantastic because, I can get such cheap money, and whatever I get on the rental side, I'm going to do well. But because they were financing with floating, not fixed rates. A lot of people are familiar with when you take a mortgage in the US, it's a 30-year fixed rate. That's a retail mortgage. But when you're doing construction finance, it's variable. And what happened is that rates went up dramatically. So things that looked great when interest rates were close to 0 or 1, didn't work when interest rates got up to 5-6%. This is on SOFR. Now we would pay a margin over SOFR. So typically you're paying about 3% above SOFR. So when we invested our first fund, we closed our first fund in this period when interest rates were at the highest. So it's much better to invest, to have an investment that works out when rates are high than when rates are low. And what we've seen is that rates have come off about 1%. So that's been some benefit to our projects. But importantly is that when we're looking at our projects, is that our developers, we hedge ourselves so that if rates run away with us, we are protected. So, there's a lot of checks and balances within the system. Another one, I can talk about on project risk, is that by the time we invest, there's a maximum price. It's called the GMP, guaranteed maximum price, where at least 85% of the cost is guaranteed by the contractor. If that cost turns out to be higher, it's for the contractor's account. If it's lower, we get the benefit. So then again, you have to be with a developer with a big balance sheet. If you go with someone who's on the cheap and then all of a sudden costs do run away, which also happened in this period, inflation was rampant, is a lot of developers or contractors couldn't fulfill. They went under. So you've got to be, you do have to do your due diligence, and you do have to go with quality operators. And then the last one is investment risk over there is, we are diversified. So we have, 3 different properties. It's not a massively diversified portfolio, but we're not just one development, and we're not just in one region. And I did mention the trade-off between inflation or interest rates and rental income. So there's somewhat of a natural hedge, which is quite good in property, is that it's never fantastic because, you don't, generally speaking, you have at it, but the expectation is you're not going to have phenomenal growth and low interest rates. You're going to have one or the other, and that's where you have this sort of natural diversification with this type of investment.
Stephen, we're coming to the end of our conversation tonight, but there is an important question here from Gareth. He says, do you have a date at which the fund will or needs to close for the fundraise?
Yes, perfect timing, Alec. So the anticipation is that the subscription will close on the 23rd of April. So we've got about 3.5 sort of weeks, just under 4 weeks, let's say. That is the anticipation. So we will have a hard stop date, and at the moment it's around the 23rd of April. We are just waiting for that to be finalized, but that is our expectation at this time.
And what's the minimum investment that you envisage? That's from Bertie.
Yeah. So, Alec, the minimum investment is $50,000.
Mm-hmm. Okay. And then from your side, up to how much do you need to be sure that the investment goes ahead?
So we are raising $5.5 million. And as I mentioned, we are confident of reaching that goal. So we have commitments from investors that have invested with us previously. Obviously, it's great, to be speaking to you and your fantastic tribe, of which I'm a member. So we are trying to, diversify our investor base and also reach more people, because we think this asset class has got a lot of room to run. So that's why we want to, open it up to more investors to get exposure and to better understand this asset class.
Martin wants to know, can you talk about the returns from the first AMC? Did you also target 10 to 15% there, and was it achieved?
Yes. So the first AMC closed just over, let's call it a year ago. It was early March of last year. So that is still in progress, but we are on track to be at the higher end of the 10 to 15%. As I say, I don't want to, who knows? It's, anything can happen. But in terms of our projections are on track. And if anything, we are surprised on the upside. So, we are confident of achieving at the higher end of the range. But as I say, we don't want to make guarantees. Anything can happen. But our expectation is that we should be at the higher end of that.
And that's all in US dollars. Is there anything on this chart, on this slide, that you want to highlight?
Well, I think the important point is that if people do want to invest in this, the way that you there's a few ways to do it. Firstly, it's offshore money. So if you have money offshore and you have a brokerage account with any one of these companies, Swissquote, Credo, DMA, then they are able to trade the AMC on your behalf. If you don't have one of those, then you would need to open up an account, and we can help people just navigate that through the process. There are other ways to invest it. You can invest via a living annuity. That's quite interesting as well, Alec, is that you may know this, but a living annuity, when you go from a retirement annuity or your pension fund to a living annuity, you're not subject to Reg 28. So you still get the tax benefits of a retirement annuity, but you have much more investment flexibility. So you can invest, via a living annuity. It's got to be with certain providers. So we've got clients that have invested with us through Momentum Living Annuity. We've got clients that have invested with Old Mutual and Glacier International. So there are various ways to access this, but not everyone's going to be able to offer this. And people, may need to, if they want to find out more information, please, drop us an email, and we'll engage with them.
Gareth's, I guess, final question is, if I pass away unexpectedly, are my holdings in the fund transferable to beneficiaries, or are there contingencies for liquidation for the estate?
Yes. So Alec, this would be treated as any other investment you hold. So obviously your estate, depending on, whether it's spouse passing away as well, and then, whatever the executor of your estate does with that asset. So it'll be no different to, let's say I'm owning, an iShares ETF or, another mutual fund or security. It will happen the same way. The difference being, because it is an illiquid investment, we would get notified as the product sponsor, and then we would have to find an investor if the person wanted to sell to buy that from the deceased estate.
Bertie's follow-up question: I see you're aiming at 10 to 15% per annum. So if you envisage a 4-year investment period, are you looking at a capital gain of 40 to 60% over that period?
Well, yes, I guess. Yes. Obviously, with compounding, it's going to be a bit higher. Mm-hmm. Because it's not just 10 times 4, but, roughly 45 to, just under 70%.
And there you have it. Sleep well at night. Stephen, the final slide, just to recap, and probably if you could go through this quickly and help us there. Before you do that, though, if somebody wants to, say I now want to put my $50,000 in, I can't just phone you up and say, hey, I've got $50,000. I like your story. I want to invest in it. And you can assist me there. Do I have to go through those different channels?
Yes, you would have to go through the channels. And sorry, Alec, it's a very important point, is that our subscription hasn't yet opened. Okay. When it does open, then there will be a term sheet. And then all investors will have the opportunity of reading through the term sheet, and then engaging with us or with their broker. And then we can, explain to them how they would need to give, and should they wish to, a trading instruction, to their broker.
So you get someone like Magnus Haystick, who would then get his team to really look through the term sheet, tell his clients that they think it's a good idea. I could then say to Magnus, here we go, I want to put the money in, here's $50,000. And is that the way you go forward?
Now, that is a way. Obviously, if someone has a financial advisor or a tax advisor and they want them to have a look at that, we would encourage them to do that. And we're very happy to have a discussion with, a Magnus or whoever else. What we found so far is that, our investors are doing their homework. They are speaking to their trusted advisors. Mm. But when it comes time to invest, then often they have a conversation with us because they say, well, if I do have a Swissquote account, what do I do? And then we'd say, well, here's a trading this is a trading instruction and this is who to speak to, as an example. Some people do it on their own, but most people sort of engage with us to work out how best to execute that. Because as I say, if you're already on the Old Mutual International platform, then we can say, this is who to speak to there, if any assistance is needed.
And how do they get hold of you? What's your contact details? Obviously, we'll have it on the site and we'll put it on here, but it's also good for you just to tell us.
Yes. So, okay. Sorry, Eric. Okay. So they can email me, Steven, STEVEN, at SWAN WM. That's SWANWM.coza. There are links to our website, and there's a contact the request form over there. They're very happy to do it that way.
Magic. Well, that hour has literally flown. No, not literally. It has flown by. It's been fascinating, Stephen, talking through your new life, your new world, and I'm sure that the tribe is going to love to learn more about this. We will be posting the recording of this onto the Biz News channel, and Stephen, as he's mentioned, will be available for much more in-depth investigation on it. And I'm sure that coming close to the end date, we'll pick up again, have another chat, Stephen, to see exactly what's happening there. But thank you for sharing it with us. It's been a lovely 7 o'clock start. It's kind of it's very different. We've been having most of our webinars at lunchtime, but I guess most people watch it in the evenings anyway. So for those who joined us live, thank you. And to Stephen, Nathan, it's been a pleasure. Until the next time, cheerio.